Guys, the earlier video that we did about stop loss placements going into key economic events, um, there's something else that I quickly just wanted to explain to you guys. And I think that can also help with the way that we approach these types of events. And I'll be using that March and that May FOMC decisions once again as really good explanations of what we're talking about. Now, what we saw with both of these two events, if we just go to a lower time frame. Let's go to the March decision. What we saw is directly out of the decision going into the press conference, we initially saw a very big pop to the upside in the US dollar, looking at the dollar index here. A big pop to the upside. Now, for those of you that was trading with us at that time, I think we were short trading into the event from somewhere within this area. I can't exactly remember where. And we were also lucky enough to literally, sell the high on this. We don't get that lucky very often. It's very, very lucky entry on that one. But the reaction that we're looking at here, I think, is very important because we had the exact same reaction in that May decision as well. And I want to explain why we see these types of reactions, and that can also help us to prepare better for these types of events and help us to prepare for how the markets might react when we get specific outcomes for policy decisions. So we had a very big spike to the upside, and then the price dropped quite dramatically. Now, if we take a quick look at the May decision, it was a very similar situation where we had that first initial spike to the upside, quite a violent move, and then eventually the dollar gave up most of that and continued to push to the downside. Now, keep in mind that our anticipation for both of these two events was very similar to the one that we had going into today, where we had very, very bullish positioning going into it. So the dollar had been appreciating going into the event. Dollar had been appreciating going into the event. We have the exact same thing right now, where the dollar has been looking stretched and appreciating going into the event. And we were looking, and this is very important to understand, we were looking for both of these two decisions and today's decision as well. We were looking for a Fed to come out hawkish, but not hawkish enough to surpass the very high bar that the markets had priced in for the Fed at that time. If you guys go back to the reports we uploaded to the loaded to the videos, the preview videos, you guys would have seen the same thing that we said, is that we thought the Fed would be hawkish, but the question is, would they have been able to be hawkish enough to continue seeing the markets buying the dollar, to continue seeing the markets buying the dollar, and obviously right now, again, to continue seeing the markets buying the dollar out of the event. So it's very important to understand this caveat, because going into today's session as well, we're not expecting the Fed to be dovish. We're expecting the Fed to be hawkish, but we're expecting a possible, we think that there's a high chance that the hawkish bar is very, very high for them. Think about it this way. In any normal hiking cycle, a 50 basis point hike in itself is very, very hawkish. Now, in today's session, because the markets have priced in a super aggressive 75 basis point hike, if we get a 50 basis point hike, that will be seen as a quote unquote dovish surprise, but it won't be dovish in the sense of the bank, not hiking rates or holding rates steady or cutting rates. 50 basis points is still very, very aggressive, right? It's still very hawkish. And that's very important to keep in mind. And I think that explains a lot of the post-decision reaction that we had in the US dollar, and something that we could potentially see today as well. So what do I mean by that? Well, if we go to the March decision, the reason why we had that, in my opinion at least, the reason why we had that first initial spike isn't because the Fed didn't come in hawkish. They came in hawkish, which means that the algos, which normally trade out of key events, they jumped on those hawkish comments. They jumped on the hawkish policy decision, and that sent yields higher. It sent equities lower, the dollar higher, gold lower. But very quickly, that move started to reverse because the markets realized, hey, this isn't really a surprise. It's enough for me to take profit on the trades that I traded into the FOMC. That's very important to understand. So that hiccup we had to the upside wasn't the markets, wasn't because the Fed didn't come in hawkish. The decision was hawkish. If you compare it to any other type of cycle that we've been in before, it was very hawkish, but it wasn't hawkish enough for what the markets had already priced in at that time. If we compare that to the May decision, very, very similar. They came in super hawkish back in May. It wasn't a a dovish decision by any means. It was hawkish, but the main point was, would they have been hawkish enough to see a sustainable move to the upside? That's very important for us to understand. If you guys give me a second, let me just quickly find something here to just to explain this a little bit better. So in a decision like today, it's important to keep that in mind. Even though we are looking for a possible dovish surprise, it doesn't mean that we think the Fed is going to come out super dovish, right? We a 50 basis point in itself will still be hawkish. That's not going to be enough though to see a sustainable move higher in the dollar, if they don't deliver on what the markets have already been pricing in. So it's important to understand that, if you look at the market is essentially, it's essentially a discounting mechanism, a forward-looking discounting mechanism. It's not going to wait for today's decision, to rally. The dollar isn't going to wait for today's decision and a hike of 75 basis points to rally. The market is going to start pricing in that 75 basis points as we go into the meeting. But then, if we get exactly as expected, that's normally when we get that sell the rumor, buy the rumor, sell the fact reaction, where the markets have been buying the dollar on a rumor of a 75. But if the Fed can't deliver more than that, we could see a move to the downside. So this is I'm just using Twitter here for a second, because that's where we posted some of our thoughts for that FOMC. And what we said there was the exact same thing. Remember, this is the May decision that we're looking at here. The Fed has a very high bar to surprise markets, even more hawkish from what is already expected. So what we said there is what to expect from this week's FOMC: a hawkish Fed, that is expected. What does that mean for the dollar? Probably downside, right? And the reason for that is what we're trying to explain now. It's not that we're not thinking they come in hawkish. A 50 basis point in itself is hawkish, but it's probably not going to be hawkish enough. It's not going to be hawkish enough to surprise on the hawkish side based on what's already been priced in. Now, why did I explain this? Well, there's a high chance that even if we get a 50 instead of a 75, that the initial reaction in the markets could still be dollar upside, even in the event of a 50 basis point hike. But if it's a 50, and once that algo move is played out, we could see a very similar spike higher and then a reversal to the downside. So it's just very important to keep that in the back of our minds. It's a very important caveat to understand, not just for the FOMC, but for any type of event that you're trading into. Even though we are looking for a quote-unquote dovish surprise, that doesn't mean that the Fed will be dovish today. Even if they follow that route, it'll be seen as a dovish surprise, but a 50 in itself will still be hawkish. So I hope that makes sense, guys. Just a very important caveat that I wanted to explain as we go into that FOMC decision.